Welcome to the Canadian Wealth Secrets Podcast with Kyle Pierce and John Orr.
We are recovering high school mathematics teachers and education consultants whose entrepreneurial spirit led us to begin multiple businesses in real estate investing, digital courses, and coaching and consulting after the bell rang at dismissal time.
Fast forward a decade later, where we've grown our portfolios and our time freedom to a point where we can now help entrepreneurs, business owners, and investors to grow their wealth into a legacy that lasts generations through hidden investment and tax secrets your financial advisors won't believe are true. John, I'm super excited about this episode. And hey, friends, I get it. Probably a little bit clickbaity at the beginning here. You're probably wondering to yourself, what the heck are these guys talking about? Are we about to head down a big, massive Ponzi scheme rabbit hole? And the answer is no, you are not. We are just trying to dress up an opportunity, as we mentioned, that's available to all of us. But again, most of us don't actually understand, right? Like, John, if we rewind back to a lot of the episodes, the whole premise of this particular podcast is Canadian wealth secrets, right? So we're really trying to unpack some of the things that we wish we knew maybe a lot earlier in our journey. And we're just trying to make them a little bit more mainstream.
Yeah, exactly. I think like when we always say like, what's the secret sauce? Like, what's the wealth secret sauce? We're trying to think about like, what are some of the things that we need in our lives? You know, what are the things that we have to, we want to do the, operations. We want to do, choices. We want to make these things, but how can we make those choices so that, we not only achieve the things we want, but we at the same time, that's the secret sauce we're always looking for, is like, how do we do that and grow our wealth? Or how do we do that and pad for the future? Or how do we do that and plan for the legacy that we want to leave with our families? Like, that's the secret sauce we're always after. And in this case, it's like, how do I safeguard, some of the things that we hold dear? And how do I safeguard my role in a business? Or how do I safeguard the work that I do? And at the same time, not just throw money down the drain.
Totally. And along this journey as well, and in the intro, people hear every single episode, they hear that, both you and I have math degrees. We were high school math teachers for a significant portion of our working lives, right? That was sort of our main job. We loved doing that job. But the reason why I'm highlighting that is because, you and I tend to sort of begin our exploration in the wealth building space around the numbers. So we start from a rational perspective, but even when we use the numbers and we crunch numbers and we look at the expected values, right? We look at the probability of something happening. We then still have to battle this emotional side, right? So something I'm seeing, in both you and I, and even Matt as well, is that we run the numbers, but then we still also have to pause and sort of think about how we feel about something, right? And even though probability might suggest over time that something is going to work out, we are like, actually now, I don't know if it's just getting old, if this is what all the financial planners early in our lives were telling us about, that, you take on more risk typically when you're younger and less risk as you get older. We tend to look for the easiest ways that we can protect and multiply our money. And today we're going to talk about one of those opportunities that, again, I think is just misunderstood, much like whole life insurance, as we've talked about at length on some previous episodes. We're big fans, massive fans, but it does take a lot of time and effort to understand what it is and why you're actually doing it. So today we're actually going to talk about another tool that actually, and like we said in the beginning, I took an actual example, and this particular individual could put in $100,000 into this thing, into this tool. And if a set of conditions were to happen, it would essentially 5x. And if those things didn't happen after a given set amount of time, he would get his $100,000 back. And for some of us, when you actually think about that, just from a numbers perspective, you're going, well, why wouldn't I do it?
Right. Yeah. And I think like sometimes when you think about that, you're thinking, okay, wait a minute, like isn't that isn't that the property that sometimes whole insurance or permanent life insurance has? But then at the other time, like what, term insurance doesn't do that. But then also, how do I account for, paying money? Like, so for example, like you're talking about, this tool that we want to put money into, but it's also like safeguarding the, like I'll say, the work we do,
Mm.
because so you're talking about, having critical illness insurance,
You
and
just
and
let the
typically
cat out of the bag, John.
that's okay. They need to know. They need to know. But what I think, why I think it's important to know, like we don't need to like string them along too much, Kyle. But I think why that's important to know is that, if you have a T4 job like we did, and I don't think I thought about this, and this is why I think everyone needs to know that this is what it is, because it can be such a great wealth building tool, and remember, do the other thing anyway, which is,
Mm.
in case, safeguard, ourselves and in say our businesses. Because, if when I was thinking about working at the school, in the school board, is like, you knew that when you got those safe jobs, that you got your benefits package. You didn't have to worry, you didn't have to think about it.
Yeah.
Like if you got sick, your benefits package took care of you.
Yeah.
You got your 90% or your 99% or whatever it topped up to be. No matter what sickness you got, you still were going to get paid. And that was part of the union. The union negotiated to get this great benefit to keep everyone safe.
Mhm.
And, so there's that side of things. But I think also it's like, but but part of that, like, you're paying into your benefits package and you never get that money back. And I think, like, that's the thing that
Yeah, and
that
most are
I
not
like to
aware.
consider.
Yeah,
Right.
they
Like, you
just
just
like, oh,
paid,
I
it
didn't
just
know
comes off
that
your
that was
paycheck. Like,
happening.
this
Totally.
is the right. It's like you've got this group. This is the thing about a group. Like, you get a group defined benefit plan, and that plan you pay into, but it gives you all these benefits. So you don't even think about it because everyone does it.
Mhm.
Everyone has to do it. It's like part of the, or you can opt in and opt out. But I mean, like, no one does. It's like that whole power of, like, the default is the opt in. But I mean, you don't think about it. And when you start to think about it, because that's what we're doing here on the podcast, like I said in the, right after the intro, is to think, how can I do that? How can I make sure that if I get sick while I'm like, I don't die, I get sick
Mhm.
in my place of business, and I either can't work or maybe I do work, but I'm just sick. And, you know, does that benefits package, it would kick in, but I was paying for it. And what happens if I don't get sick?
Right.
That was part of that thing, and part
And
of
what
part
is
of
it
the
that I'm
deal.
actually going to get, John? Because I'm going to be honest and say, and I don't know about you, we've never really talked about it in like in the particulars, but it was only after I left. Again, same idea as the pension idea. When you go back to the pension episode, where I was like, how do I recreate my pension? Like,
Right.
how do I get something as essentially rock solid? And we ended up creating something even better than what we had as the
Totally.
pension. So we were like, and it was like safer and had more benefits. So if you haven't checked out that episode, go and roll back to that episode on recreating the Ontario Teachers Pension Plan. But when it comes to the benefits side, right, I didn't actually know all of what I got. I had little bits and little pieces, and I knew I had some things. I knew, for example, that it was about, I think, 3 times or 2.5 times my salary was my life insurance. Now, I
Yeah.
thought for
That's
some
life
time in my
insurance.
life that that was enough for life insurance. You actually realize that you're like, well, unless you only are planning to work for 2 to 3 more years and your family only needs 2 to 3 more years of your income, then that's not enough. Like it's actually making people feel more comfortable and confident than they probably should be. When it comes to the other benefits, though, like you were talking about disability, there's nuances to it, right? It's like
Hmm.
short term for a certain number of days, you'll get your 90 or
Yeah.
95%. But then eventually, when it gets to long term, you'll go down to, I think it's 50% of your income. And then it kicks in from that date there. People
Yeah.
who don't have benefits like that, they should definitely be looking into it or figuring out where their gaps are. Because for teachers, for example, they take care of that short-term period, but in some businesses they don't. So in some, T4 jobs, you've got disability, but it doesn't kick in for 60 or 90 days. And it's like, so like, what are you going to do for those? Like, I wasn't planning to take 3 months off, but you know what? Sometimes that just happens. Now, here's the interesting part, John. So you let the cat out of the bag. The tool we're talking about here today is critical illness, and we like to call it like a free lottery ticket. Essentially, it's like a free
Hmm.
lottery ticket
Mm-hmm.
because if you don't, and I'm using bunny ears,
It's
don't
like a
win.
backwards lottery ticket. Like
Yeah, it's
you don't
like
want
actually
this to become true, really.
exactly. It's sort of like you put bunny ears here because it's like if you win, which is like, well, you didn't win because you
No.
contracted a critical illness. But on the other hand, if that happens, you'll get a windfall of money, much like a life insurance policy, right? Same idea. Even if you can keep working, if you contract one of the 20 plus,
Like cancer? Is that what
like
you're talking about?
cancer's included, you've got stroke, you've got heart attack, those are the big three, and then they got a bunch of other ones in there like blindness, for example.
Hmm.
Like if you get blindness, like the chance of that happening, we look at the stat on it,
Right.
it's like it's probably not, but they throw it in there. They throw in all kinds of other ones as well, but the big three are in there. Heart attack, stroke, cancer. And cancer does have some nuances to it. Different types do different things, and every policy is different. But the whole idea here, and something I want to underscore, is that, John, you and I, when we were teaching, did not have critical illness insurance. There was no
Right.
critical illness. There was disability, which serves a purpose. It helps to bridge the gap for your income, right? So it's like,
Yeah.
you get 90% and then it scales down. And then the longer you're off on disability, then eventually goes to half, but it's not taxable. So it's like half. And, so you're close to maybe your after tax income. So that part's okay for teachers, but critical illness is not something you have. So for example, if you contracted a critical illness that allowed you to keep working and you wanted to keep working, or you could keep working, right? If your doctor says, hey, listen, like there's no reason why you won't, I'm sure your doctor would write you a note if you wanted one.
Mm-hmm. Mm-hmm.
But if not, what would happen is if you have critical illness, you will get a windfall of money that comes to you, which in my mind is like, okay, I mean, it doesn't make me feel better about my situation, right? Because I'm dealing with a heart issue, or I'm dealing with a, stroke, or I'm dealing with some of these other illnesses. So that part's not great, but I'm sure that it would at least make my financial
Right.
mind feel a little bit better. Maybe, if let's say it is a life-threatening sort of critical illness, right? Where maybe there's
Yeah.
a certain amount of time I have or whatever, to have that windfall kind of come in now instead of, say, waiting for life insurance to happen after, right? It's like it could allow you to maybe have a better time given your really unfortunate circumstance, right? So I
Right.
try not, I know we were kind of making it, this whole lottery ticket idea, but it really is a sensitive topic. But on the other hand, I was never in the mindset along the way that I needed that particular thing. I was like, it's fine. We'll be
Right.
okay. Like we'll just sell some real estate. If that happens, if my life changes and flips upside down, I
Mm-hmm.
don't really care so much about my wealth building anymore, because like, it's that my priorities are shifting to the time I have left, or the
Right.
way I'm going to live my lifestyle now, which is very different. However, the way that critical illness is actually designed, when designed the way it should be, in our opinion, it's actually a no-brainer, because you have an opportunity to receive all of the premium back after
Right.
a given set of time if you don't experience a critical illness, which so again, it's like a win-win in a way. Like it's like,
Right.
it's a win
Well,
if
walk us
nothing
through.
happens, and it's better than what you had if an unfortunate event were to happen, that at least you have this additional buffer financially to be able to take care of your family, do the things you all
Yeah. Yeah.
wanted to do as a family together.
Walk us through that example that you said. Like you said, this was an actual kind of case study that you were working with one of your clients on, and you said like the 100,000, you get the 500, and but then you get the money back if you don't.
Yeah.
Like walk us through like what that looks like. And then what we can do is after we kind of see what that means. Like when I say 100,000, I'm like, am I putting $100,000 now?
Yeah, exactly. I know.
Like
You're like, wait a
that
second,
sounds
how does
scary,
this
right?
actually work?
So walk us through that and the timeline. And then what we can do is after that, let's talk about like when I should get this. Like
Right.
should I get this now, or should I
Yep.
be taking care of some other things first?
Totally. Yeah, these are all great questions and really important wonders. So first and foremost, when you go to get, critical illness, you can get critical illness essentially from any insurance company, right? So you could
Sure.
go and talk to your insurance guy that you've always talk to whoever. You can talk to us, right? We handle this type of work as well. We're going to talk from a personal perspective first. For our business owners, stick with me because you need to understand how it works in general first. And then I want to share how this opportunity gets even better for incorporated business owners. So, it becomes, again, like almost a no-brainer on the business owner side. So
Right.
we'll put that on the, we'll put a pin in that part for now. And we're going to talk about David, who is 32. And actually, David was a listener of Canadian Wealth Secrets back when it was Invested Teacher. We hopped on a call. This is a couple months ago, and going through his wealth plan. There were some, we'll call it like some chinks in the armor, like there was some missing pieces there. So we were talking about wealth building, but I was concerned about the protection side. So this is something we discuss when we get on a wealth call. We sort of go, listen, I love that you've got plans to, he was going to add additional units to an investment property. He's got a significant amount of money ready to go to do all this stuff. He's doing great. But it's like almost like just like we did, John, like leapfrogged to that place and didn't really take care of home base first, especially since home base is such an easy thing to take care of, especially like even small term riders or term insurance policies and such. This was one of those ideas I had for him because he does manual labor for his day job. And he is the one that's doing all the work on, on these renovations and so forth. So without him, a lot of his big plans are gone, right? So right there, there's a need. But then there's also the benefit of the fact that if nothing happens, this money isn't gone, right? So the way this works, you have two options for critical illness. The cheap option, like I call it like the term insurance option for life insurance, the cheap option is you buy a term critical illness policy. You can buy it from anywhere. You buy it from Sun Life. You can buy it from, RBC. You can buy them, from any of these companies that are out there. But a term, just like with life insurance, you're renting this insurance. And for a lower cost, you are able to monthly or annually, however you choose, pay into this. So it's not like, hey, take 100,000 and put it in. You're just paying over time. And with a term policy, you can cancel it. You can cancel it after month 3. You can cancel it after 3 years. You can cancel it after 30 years. A lot of companies will allow you to run this until you're 75. Okay. So term 75 is sort of the typical sort of length of time. And again, over your lifetime, there's more than a 50% chance that you will contract one of the big 3, right?
Which sounds scary.
Kind of crazy. Like, so you do expected value and go like, so that it's like a high chance that you might contract it. It doesn't mean that you're going to actually die, right? But that you will actually contract one of these things, which means a critical illness policy would pay out, right? So this is where we bring the probability. You got to go from emotional, and then you have to have rational. You got to be flipping back and forth. It's like, I don't want that to happen emotionally, but rationally you're going, I mean, holy smokes. Like, I don't like the chances, to be honest. So when we look at this, we can pay less money. In this case, David was 32, non-smoker. He was male, and he was looking at a $250,000 policy. Okay. We used 500 in the example but $250,000 policy, meaning if he puts this in force and something were to happen, contracts a type of cancer, he like I said in this particular one, if he goes blind randomly, or whatever, any of those types of qualifiers that may happen, has stroke, any of those things, he will get a windfall of $250,000, right? Even if he's working. So like, it doesn't have to be like, hey, you contracted it and you can't work. It's like, no, it's you contracted it, you met the term, like you met the condition. So on a death benefit, if you die, you met the death benefit condition. Here, if you meet one of these conditions, you're going to receive this benefit. So that was $200 a month for him to do that. Now, a lot of people are going, $200 is a significant amount, right? So right away on a call, you were saying like, who is going to consider, who's this right for? And I'm going to argue that if you hop on a call with me and you're like, I have nothing, I have no investments, no savings, no nothing. It's like, we're not talking critical illness yet. It's not that is not where you should be putting your $200 that you need to scrape up from under the couch or whatever you're going to do. You should be investing. You should be saving, right? So probably starting with a savings fund that's going to eventually turn into an investment fund, right? We have an emergency fund episode that people can check out.
Right. We want to build that
Stocking
up
away
first.
your RSP if you don't have a pension, putting it tax-free, those types of things, and taking care of term insurance at that point, like at that stage. Term life insurance, I want to be clear, okay? So you want to make sure that your income can be replaced for at least the amount of time that you plan to be working, so that any of your dependents are taken care of. All right. For someone who actually has these things in place, they've got some life insurance, they've got investments, they have a plan, right? They're doing this sort of thing. They're on a wealth building journey already. Along that wealth building journey, we start to incorporate tools like this. All right. So even though this is a great tool for everyone, it's not the best place to put that $200 a month if you haven't taken care of the other pieces. And John, you and I have been crafting our sort of journey, right? We're the blueprint that we have on our website. We're updating this blueprint so that it's going to be a little bit easier to follow the path, to figure out where are you. And if you think you're here in the journey and there's gaps before it in the journey, that, you know what, we should probably have a chat and try to figure that out. All right. So for David, this was a good fit. He's got investments. He's got a good job. He's got some life insurance. He's got all of these other things in mind. And we were looking at this particular policy. So $200 a month. But the negative is if he cancels in 3 months, if he cancels in 3 years, if he cancels in 30 years, he receives none of it back. Just like term life insurance, he will receive none of the term critical illness insurance. All right.
Okay.
So ask away here, John. Is there anything that's circling in your mind here that you think somebody in the audience is asking themselves right now?
Like you just said, you just said I get my money back, but we said, you do get your money back. So,
I love the way you phrase it. You phrase it like it's like, well, wait a second.
Why? When does that happen? Like you told me we get our money back.
I love it. I love it. So if you do it that way, right? Just like, and you'll notice some similarities between term life insurance and permanent life insurance, right? Here, this would be term critical illness, and we don't call it permanent critical illness because it will max out at about 75 for most companies, most policies. But you do have an option. You have an option that you can put what we call a return of premium on cancellation or expiry. So this is an added, we'll call it a cost, but it's actually turning this more into a forced savings if you actually do the math here. So we've got David. He can pay 200. If David said, Kyle, I want to do the 200, I'd be like, you know what, David, we're not done the discussion yet because I didn't tell you how much the return of premium is. The return of premium allows you to get every dollar that you've put into this policy back after a period of time. So in this particular case, it was $93 extra a month for David to be able to get his return of premium. So it's about $300 total. So we went from $200 to $300. And now people are going like, whoa, this feels really expensive. However, in case one, if I put $200 in a month, every single month for 1 year, 10 years, 30 years, I get none of it back. When I put $300 a month into this, 1 year, 10 years, 20 years, the key is if I do it for at least 15 years, I will get 100% of my premium back with this particular insurer. So every insurer has different, nuances and different rules. But with this particular example, if he canceled after 5 years, he'd get 25% of his premium back. If he canceled after 10 years, he'd get 62% of it back. If he cancels after year 15, year 16, year 20, year 35, he gets 100% of the money that he put back, unless there's only one other option, unless he contracted one of those critical illnesses. So this is where we talk about the quote unquote free lottery ticket, because you are, if we think of it in a rational perspective, you are essentially socking some money under the couch, right? So I
Right.
look at it as like a bit of a forced savings account where you're earning no interest. So there's that
Yeah, that's
cost,
right.
but
That's the
the
cost.
probability brings your expected value up to a level that's fairly significant, right? So if
Right.
you're going to own this thing, say for the rest of your, until you're 75 or at least the next 15 years, probability would suggest that actually your expected return is higher. So you get either zero return or you're going to get a really big return, right? You're going to
Mm-hmm.
so if he goes 15 years and something happens in the 15th year and he contracts something, he's put in there about, call it 50 something $1,000.
Yep.
At $50,000 has now turned into 250.
Mm-hmm.
If it happens in the first year, he put in,
Right.
$3,600. It turned into 250.
Yep.
If it's in year, 35, your
Yep.
return's going to be less if something happens, but it's still going to be greater than zero. So if we
Right.
actually run the probability, you can literally go and say, well, if I take all of the probabilities of any of these things happening to me over my lifetime, I can
Sure.
look at any year and I can calculate the expected value by taking the probability of it happening multiplied by the payout to determine whether there's a return or not. And the
Yeah.
reality is there always is, because the probability is above zero. So your return, your expected value is above a 0% rate of return. So
Right.
rationally, without emotion, if David has that money and he's even thinking about, let's say he has a savings fund taken care of, he's got a few 3 to 6 months of expenses socked away. Instead of continuing to put that more money into that savings fund, he might choose to start now putting it over here. So it's more forced savings, but also with a quote unquote expected return on it, just given the probability of any of these events happening.
Yeah, and safeguarding your mindset, right? Like just saying like I want to have that anyway. And so instead of just, tossing it away to say I have insurance in case I get sick,
Yeah.
you want to do it in this particular way, because I think what you're saying, this is where the secret sauce is. If you get the extra, the optional benefit of your return on premium, yes, you're saying I'm gonna do this for 15 years. You were gonna do it anyway, because you wanted that safeguard. Why not spend the extra, $93 in this particular case and say I'm gonna get my money back? And the only thing it actually costs you is the opportunity cost of your $50,000 in this particular case, to say, look, I didn't put $50,000 into the stock market, or I didn't put $50,000 into a rental property,
Yep.
But what I'm getting for my opportunity cost is I'm getting peace of mind. I'm getting, the like you said, the probability sounds scary when you say I may contract this, this critical illness in my lifetime. But I'm covered, if I do this,
Totally.
and I get my money back. So that to me is a secret sauce that you want to think about when you decide, am I covered for that type of event in my life? And make sure that, like what you said, Kyle, is it's important to kind of know where you are in your
Mm-hmm.
trajectory of your wealth building journey. Is like, this might not be the right thing for you yet, but it will be someday if you're kind of moving in the right way that, we're talking about here on the podcast.
Yeah,
So
if you're
I
going down that path, right? If you're going on
here's
a
a
wealth building path and you're successful moving along that path, there will be a time where this makes sense for you,
yeah,
or there should be a time
right.
where it makes
Well,
sense for you
here's
if
a
you're going to hit that notch in the road, right? Where you
right.
should be considering it.
Here's a question, because we've been talking, we've had many episodes in the past on whole life insurance or permanent life insurance. And let's say you kind of like took us up on that. You met with Kyle, and you and him went down, looking at your scenario to see, what is the right option for you. And you got, a whole life policy. And you're using it, and you want to use it the way that we've been talking about here. You want to use it as a tool to do other things with, tool to buy real estate, or tool to invest in your future, or a tool, for emergency fund, because that was one of the tools for the emergency funds, or a tool to buy the car, like we talked about, that to be. But I wonder, Kyle, could it be used as a tool in this case? I know that the, this particular insurance, gives you this kind of like windfall and you're alive. But I mean, like, could you use whole life insurance to cover your butt in this case too? To say, look, I didn't die, but if I get sick,
Mhm.
could I just withdraw $250,000 from my whole life policy 15 years from now.
Totally.
And it
Yeah.
covers, it covers me in that case so that I have that windfall of money. The difference is when I do die, that benefit that I withdraw will get paid off, but I will, because I'm going to borrow that money,
Hmm.
against my policy, there's going to be an interest charge. So what's your thought on like using that as a tool versus critical illness? Like, why would I, if I already have a whole life policy and it's large enough to
Yeah.
cover this kind of thing, should I go critical illness or should I just leave the policy?
I love this thinking here. This is such a great question. I do want to come back to opportunity costs as well, because there's one last thing to consider on that. But while this question's fresh here with us,
Mm-hmm.
I think every scenario is different. I think for a lot of people, depending on what their goals are, it's going to be really important that with their goals, that they're thinking through what their goal is for, say, that whole life policy. So if your goal was to have part of that policy cover the event of a critical illness or
Right.
whatever it might be, absolutely. I mean, you can definitely do that. There is nothing holding you back from doing that. And again, that's where someone who does purchase and decides to put money into a participating whole life policy as a tool. Typically, we want to use that as a tool for reinvestment. That's usually
Mm-hmm.
what we're kind of the
Right.
stance we're taking, or for legacy as well. So when people have, you know, they're busting at the seams in their RSPs, their tax-free savings, or they have a corporation with a lot of retained earnings. Like, these are cases where permanent life insurance really makes a lot of sense, and you get to decide what that cash value is used for. So in a case where something happens, it's unexpected that contracted something, some sort
Right.
of critical illness, absolutely 100% I would be all for it if you didn't have your critical illness set up. So I would be saying that in the journey, the real discussion would be which one comes first. And for me personally, in most cases, not everyone, most cases, a permanent policy comes first. A permanent life insurance policy comes before the critical illness, because I have access to the capital in the permanent life insurance policy. I don't have access to the money I'm putting into the critical illness unless
Right.
something happens, or until I'm ready to cancel this policy and bring the money back. So I would argue that, that extra $300 for David is probably not the best fit if he hasn't, say, considered permanent life insurance, especially because he was a real estate investor, right? So you're a real estate investor. I'm like, that's the thing I want to put in place first, get that budgeted into your world. Then you can consider critical illness. Something else to consider, even though I wouldn't want to plan for this, but let's say money is tight and you have critical illness and you're like, shoot, I got laid off, or business is slow if I'm an incorporated business owner for a little while. I have access in my permanent policy to borrow for a short period of time. We don't want to do this forever, right? But for a short period of time, I could access the capital in that policy to keep my critical illness like going, right? Like, I don't want to give up that policy in year 3 or year 5 and only get a part of the premium back. I want to try to at least get it to that year 15, and I'm going to do whatever I can to make that happen. And again, strategizing around that in an emergency situation is really helpful. That's where an emergency fund comes in. Hey, if you did a permanent policy as your emergency fund, that would be a perfect place for that particular
Right.
policy to be used to kind of, help you out in maybe a tight spot or over a tight period of time. Now, I want to go back as well to the opportunity cost. So the opportunity cost you mentioned is even more complex than what you stated there, John. 100%. Everything you said is true. You had mentioned the only thing you're losing is the opportunity cost if I took the $300 and put it in the stock market, which is why we wouldn't do this instead of tax-free savings account, or instead of putting in an
Right.
RSP, or instead of putting it into a policy and leveraging for your real estate deal, or whatever you're going to do. We would do all of those things first. But in this case, when I decide that the time is right for me to start funding a critical illness with return of premium, that is going to start. And you're not losing all of that opportunity cost that you would get in the S&P or TSX or whatever you want to invest in. The other thing that you need to consider is, what is the opportunity cost Or what is the chance, if I look at probability and say, what is the opportunity cost I will lose if a critical illness were to happen next year, 5 years from now,
Right.
10 years from now? Now, I have someone really close to me, and I don't even know if I told you about this, but this week, this person that I know, I'm not going to say where they're from or how they're related because it's not public to everyone yet, but this person that I've spent a lot of time with over this past year pulled me and a handful of other people that we've been together doing some work, we'll put it that way, and told us that he has stage 2 cancer. Now, it is curable. Okay, it is curable, but oh shoot, I'll butcher the name, but it was the same type of cancer that Mario Lemieux had and recovered from and came back to the NHL. So there's lots of good things going on. But a week ago, we were all having fun. And then this week, that news was presented, to him. Now, that's just one random case here. So what's the opportunity cost for him if the goal was, I'm not going to do, say, critical illness because of the opportunity cost for me to take the 300 and put it into the stock market? Is he going to be able to continue putting money into the stock market right now while he's off work doing chemo? And I'm going to argue there's a massive opportunity cost there that's really hard to calculate. So when we think about it from the rational perspective, we also have to just keep an open mind to, hey, if there is a chance, and if we know the chance, right, if we go through and calculate the chances of these things happening over the next 15, 25, all the way till I'm 75, the opportunity cost of not having a policy like this in place may actually be greater than the opportunity cost lost in, say, the stock market. So just wanted to kind of highlight that it's actually a more nuanced discussion. And again, some people are just okay to self-insure, and that's fine. But consider that, again, the return of premium coming back, it really, for us anyway, it puts us in a spot where we can feel a little bit more, comfortable with the journey that we're on, that if anything were to happen, that we're in a better boat.
Yeah. Yeah. And I think, just knowing, that that's an option. I think that's one of those like secret sauce, moments too, is to go, I didn't even know that that was an option. I didn't know that I could get my money back in this, when I get critical illness insurance. So, that's a big takeaway from me, but in on the personal side. But I know that, Kyle, you mentioned at the top of the episode that, when we think about this case that you took us through, this was on the personal side. This was a person who was not incorporated, or is incorporated, but they wanted this insurance for them personally. But let's say I I have my own business, and I have a corporation. Is there, and I know that this is true because we've talked about it, but I mean, tell us about the benefits that come along with this if I'm a business owner and I want to also, maybe expense the cost to the business because I'm, a shareholder of the business, or I am, I work in the business, and therefore the business would suffer if I got sick, right? Totally. So what are some of the extra benefits on the corp side?
Yeah, totally. So I'm going to use you as an example there, John, because you're active in many of our businesses, right? But in any of those businesses and any of those corps, you are a key person, right? You are an important part of that business. And let's be honest, if you got sick today and you were maybe unable to work, or even if you just got sick and you were able to work, but you're like, listen, Kyle, like, I'm not spending all my time working all day. Like, you're on your own. I'm going to spend time with my family and blah, blah, blah. That's where the logic comes in for, hey, a corporation would take out critical illness insurance on you. They do the same for me, right? Because I'm a key person as well in our businesses. So the corporation comes in, and we're going to use the same numbers as the David example. David's a little younger than you, John, sadly, but it's okay. But we're going to say that the actual critical illness insurance cost, do you remember what it was, John? It's like quiz time for everyone.
$200.
It was $200 for David. So yours might be a little bit more because you're a little older. And there was a return of premium, which was about
$100.
About $100. It was like 93 or something like that. Okay. So what's going to happen is you're actually going to have shared ownership of this critical illness
Mm.
policy. So you're going to write up a contract. And basically how this contract works, some call it a split dollar.
Is this by default, or you got to do this yourself?
No, you will do it, but this is common. So if you go to,
Okay.
you can Google it, you can all these things. We're going to have a page on our website about this coming soon. But basically, the idea is that you're going to share ownership with the company. And how this is going to work, it's kind of like a JV agreement, right? When you go back all the way back through, some of our earlier episodes, we talk about joint ventures where we have a joint venture agreement. You bring the money, we do the deal. Same idea here, but with critical illness, where the company says, hey, listen, I'm going to take responsibility for the payment of the critical illness. All right. I'm going to take that payment on. Okay. I'm going to take the $200. The company does. Perfect. Awesome. The company does. Oh, wait a second. That's like tax, like reduced tax money that we're buying that with. Bonus. Awesome. We can even expense that. Holy smokes. That's pretty awesome. Like I can expense that because that's an expense. There's really no other tax benefit to why you wouldn't want to. Okay. Awesome. And then John, you're like in the contract, you're like, but you know what? Hey, Mr. Corporation that I own, Mr. Corporation, there's a return of premium on there. Do you mind if I pay the return of premium on there? And the corp's like, yeah, like we're not going to pay it, but we're just paying this part because we want to make sure that we are good if you go, and you get sick. Perfect. Okay, so you take on the return of premium part. All right.
Okay.
So John, you're going to pay $93. The company's going to pay the 200. And we're out to about 300 total. And here's what happens. Now, there is no actual tax language to tell you how to handle this type of situation. So it doesn't say in the Income Tax Act, you can do this. It doesn't say you can't do this. And so even, companies like Sun Life will have these examples on their website. They're like, here's what you could do. And at the bottom, a little asterisk that says, there's really no tax guidance on it. And no one's ever had an issue. There's never been an issue in the past. Could it change in 10 years? Maybe, but we don't know. We don't know what the future holds. All we can do is use the rules we have now. Right. And that's what I'm going to go by. And so, John, you're going, okay, so what happens? Let's say, shoot, John, something were to happen. Okay. Yep. Probability works against you personally. The windfall of the critical illness insurance money, the $250 that you had been insured for, goes to the company. Now you're thinking like, well, okay, like, wait, but you own the company. Okay, so that's positive. All right, it goes to the company. Now that money still has to come out. It's not like life insurance where I can just take this money out tax-free, but your company gets a windfall of money, which is what it was supposed to do. Right now it has $250 that it can go and try to headhunt, and it can spend that money to invest in trying to figure out like, what's our action plan if John doesn't decide to come back. Right. Now, what happens if nothing happens? So you're lucky as a human. You're just like, wow, that's awesome. I didn't have any of these things happen while we kept this policy in effect. And we've kept it for at least 15 years, right? Because we want to maximize the return of premium. In earlier years, you're going to get less than 100%. After year 15, you get 100% with this particular policy. So, John, you've been paying 93. You're like, man, I've been paying $93 a lot. But because of that shared agreement, you took on the responsibility to get the return of premium. So you bought the money back from the insurance company. The corporation decided not to take the money back by not taking the return of premium. They have a term insurance policy. They get what happens if it happens. And when it goes away, they get nothing. But because you were the one in the shared agreement that opted to pay for the return of premium, guess where the return of premium goes? All back to you, because that was the option, all of it. So in David's case, it was about 54,000 combined, the 300 times 12 times 15 if you canceled in year 15. If you canceled in year 15 or after year 15, you'd get, say, 54,000 coming back to you when you only contributed about a third of that amount.
Right. Like I was putting in $93 if I'm David in a corp, and every month, and I did that for at least 15 years. And then if we want, I can get all of that money back, but I get my $93 back, but I also get the $200 back that the corp put in. Exactly. So I get $300 back per month, in a
Exactly.
lump sum. But I only had to put in 93.
So that is like a massive secret sauce for business
Mm,
owners, to the
for sure.
point where most insurance companies, I think the highest an insurance company will allow you to do for critical illness is 3 million. Because imagine if you have a very successful business and you have a lot of retained earnings, and you know that, wait, I can use corporate dollars to buy the insurance. I can pay the return of premium personally. And if something happens, a $3 million windfall comes to the company. If nothing happens, I get all of it back, having personally only having paid a third. Now, here's the nuance
It's
that I
like you're a
want
money
you.
launderer.
It's what it's definitely what it sounds like. So here's what I want everyone listening to do, though. When you have a chat with someone, I would say have a chat with us. I'm sure you can tell now that we understand this very well. We are not tax experts. We are not CPAs. I would like to say that we know, we know the Income Tax Act, but we can't give you advice on it. So I want you to understand this nuance. Here is where the taxable uncertainty comes in. When you read the tax act, it doesn't tell you what to do in this case. So you need to talk with your accountant about how they feel comfortable doing it. And if you feel a different way, then you can share that, but your accountant and you need to come to some sort of terms. So think about this. John, you paid a third of the return of premium. Your company paid 2/3, right? So
Mm-hmm.
100, 200, right? So it
Mm-hmm.
makes $300. You paid a third. So
Mm-hmm.
one such method, which is I'm not one such method that we tend to stick with, is the fact that we're getting the return of premium back and it's not taxable and you're good to go personally. Okay. The
Mm-hmm.
other method that you can use, if you were like, you know what, I just don't want to have any, like if they change or they actually write something more specific in the act later, I don't want to have to deal with it, whatever. Okay, you'll get your 1/3 back tax free, right? Because you already paid tax on it when you put it into the return of
Right.
premium. And now you got these two coming back to you personally. All right. These two coming back to you personally as income. All right.
Yeah.
But
If they change it. If
if
they
they
change it.
change it, right? So,
Right.
but I want you to just think about that for a second, that it's like, okay, so there's, even in that scenario, there's a net benefit to you as a business owner, even if you are lucky and
Sure it
everything's
is.
out great and you're super healthy and you don't actually have to put this into force. To
Yeah.
me, that's a massive secret sauce. I think there's a secret sauce there, as you mentioned, just for the personal side, when people get to a place where this makes sense. For a lot of businesses, it makes sense from a protection standpoint, but then it also makes sense from an expense standpoint and a return of premium standpoint on the
For sure.
owner's side of things. So you've got
Yeah.
a lot of secret sauce to work with here in today's episode.
Yeah, I'm liking the secret sauce on this one. And like I got two big takeaways, Kyle, is one in this particular case, you know, when we and this is generally not just for this episode, is that when we have to do, when you want to do things that you need to do anyway, like take care of insurance, buy this or do something, or that you need to feel secure or to live your life, you want to ask yourself the question, like, can I do this way, the way that typically everyone might do this? Or can I find the secret sauce? Can I figure out, is there another way to do that and not take money out of my pocket, in the same ways that everyone else gets money taken out of the pocket? Can I keep some of that money in there, or can I actually add to my pocket and do the other thing at the same time? That's I guess really the benefit, the secret sauce we're talking about here. But generally, this is the other benefit, is that that's what we want to do. Like, we actively seek out. Kyle is the fact finder of us. Is he seeks these things out. When something that comes up that we need to do, we go and figure it out so that you don't have to. And that's what we're going to share here on this podcast. So we talked about this secret sauce. We've talked about many other ones. This is what we're doing with, the seek our podcast. So that's my two big takeaways, Cal.
I love it. I love it. Yeah. So this one for me, again, the title, not trying to be, insensitive, but really when it comes from a rational perspective, it's worth having a look at, even if you're not ready for it in your journey yet. And something that I'm really noticing, John, when I'm on calls with people, I was on a call with someone yesterday, and this person came in just through social media, not directly through the podcast. But I was on a call, and what he said to me was, it made me feel good about the work that we're trying to do. He said, I really appreciate that you weren't just trying to get me to buy a tool. You're actually asking me all the questions about my entire scenario. And what he came to me for, we actually decided is probably not the thing we want to focus our attention on right now. There's other loose ends that he needs to take care of. So this particular individual had a ton of passive income happening in his corporation. And I was like, oh, there's some things that we can do here. When we're going to have another strategy call to kind of get into the weeds and the nuances there before he wants to get to the place he thought he was at in the journey. So he had spoken to someone at a big institution, and he wasn't, they didn't ask about any of these other things. So that's our goal here. We really want people to have a clearer picture. In some of our earlier episodes, when we talk about your goals and in your financial future, and you're talking about your actual journey, you need to look at the big picture, right? It's not about a single tool coming in, because a single tool coming in at the wrong time of your journey can actually set you back.
For
The
sure.
same is true if you miss a tool along the journey and you sort of do the leapfrog. We got lucky. We've said it before on this episode. John, you and I got lucky in this journey. So did Matt, because we didn't know at the time what we should have been doing along the journey to ensure that we were as strong as possible for any circumstance, right? For any potential issue that could have come up. So, friends, hopefully you found some value from this episode. If you did, do us a solid, rate and review the show. And of course, we would love to chat with you about your specific situation and our goal is to give you at least one next step. Sometimes it makes sense to do some of the things that we specialize in doing together with you. Other times we might point you to another trusted individual that can help you with that specific part of your journey. But the most important part is knowledge. You need to have the knowledge to know what is the next step, what is the next place in my journey, so that I can get closer to that end goal that you're after. So head on over to CanadianWealthSecrets.com/discovery. We'll hop on a call together, get to know you a little bit, and ask you a lot of questions so that we can get you thinking. And typically by the end of that call, you have one or more idea to be thinking about that you haven't yet considered. And that is our goal and our promise to you. So CanadianWealthSecrets.com/discovery. And I look forward to seeing you on a call just like this. Just a reminder, my friends, this is not investment advice. In particular, it is not tax advice. Today, it was for education and entertainment purposes only. So make sure you do not construe any such information or other material on this show or in this episode as legal, tax, investment, financial, or other advice.